Banks bleeding cash. You'll lose $10,000. You thought 2008 was bad. But 2026 isn't a repeat. It's a remix. Banks aren't the problem this time, oil companies are safer than your local bank. Here's why. The Fed's balance sheet is still bloated at $7.8 trillion. They told you the soft landing was working. But the data says otherwise. Corporate debt hit $13.7 trillion in 2025, double what it was in 2008. Household debt. Only $17.1 trillion. That's right. Corporations owe nearly as much as all of us combined. And here's where it gets worse. Your home isn't just a home anymore. It's a hybrid asset, part shelter, part hedge against inflation. BlackRock owns 300,000 single-family homes. They're not buying to live. They're buying to rent. To you. And they're raising rents 12% year over year. Your paycheck. Up 3.5%. But here's the kicker. Your home's value isn't tied to the market you think. It's tied to the Fed's next move. Every time Powell blinks, your equity swings. In 2023, a single rate cut added $50,000 to the average home's value. In 2026, a rate hike could do the opposite. And most people don't even know it's coming. The banks are exposed. The Fed is lying. And your home? It's the collateral. But here's what nobody's talking about. One decision, one single Fed meeting, could flip the market overnight. And if you're not prepared, you'll be the one holding the bag. You thought 2026 would be the year the housing market crashed. But here's the twist, it didn't. Mortgage rates? Down to 5.8%. Sounds great, until you realize that's still double what your parents paid in 2020. And here's the kicker, rates could drop another full point by December. That single move could flip the entire market. Open loop, how a single Fed decision could flip the market, inventories up 22% year over year. But don't celebrate yet, we're still 30% below pre-2020 levels. Builders are desperate. Clip, builder ad, free solar panels with purchase. They're throwing in 6% concessions just to move inventory. Home prices? Up 8% year over year. But here's the surprise, rents are rising too. Vacancy rates hit 6.3%, the highest since 2010. Yet landlords keep hiking prices. Why? Because corporate buyers like BlackRock own 1 in 7 rental units. Here's the reality, 2026 isn't a crash. It's a stalemate. Buyers won't pay 2021 prices. Sellers won't drop to 2019 levels. And the Fed? They're holding the detonator. But here's the $500,000 mistake everyone's making in 2026. New open loop, they're waiting for prices to drop. Meanwhile, the smart money's already moving. You remember the $500,000 mistake everyone makes? Well, it's not a mistake. It's a war. Banks are slamming the brakes. Even safe borrowers. Denied. But builders? They're flooding the market, 6% plus concessions, $50,000 in upgrades, buy now, pay later schemes. Wait, who's in control here? The data doesn't lie. The market split in two. Luxury. Untouched. Affordable. A bloodbath. But here's the question no one's asking. Which cities are secretly overvalued? And which are goldmines? Stick around. You think oil companies are risky? Think again. The real exposure isn't in the ground. It's in the balance sheets. And right now, banks are sitting on a time bomb, one that's ticking louder than any oil spill. Here's the first loop. Why are banks more exposed than oil companies? Because oil prices can crash, but banks? They don't just crash. They implode. Let's start with the numbers. Banks hold $3.2 trillion in commercial real estate loans. That's not a typo. $3.20 trillion star. And here's the kicker, 40% of those loans are maturing in 2026 and 2027. Now, you might be thinking, okay, but office vacancies are high, right? Yes. And no. Office vacancies are at 19%. The highest since 2000. But here's where it gets interesting. Multifamily. Booming. Industrial. Strong. Retail. Surprisingly resilient. So why the panic? Because banks don't just lend to one sector. They lend to all of them. And here's the second loop, regional banks are the weakest link. They're what I call zombie lenders. They can't foreclose, because if they do, they'll crash the market. But they can't lend either, because if they do, they'll run out of capital. Take New York Community Bancorp. In 2023, they took a $1.7 billion hit on commercial real estate loans. Their stock down 70% in 6 months. But here's the thing, NYCB isn't alone. In 2023, 6 regional banks failed. In 2024, another 4. And 2026. That's when the real fun begins. Because here's the third loop, the data shows a liquidity trap. Banks need deposits. But savers? They're fleeing to treasuries. Why? Because treasury yields are at 4.5%. Bank savings accounts? 0.5%. So what do banks do? They raise rates to compete. But here's the problem, they can't. Because if they raise rates, their loan books get crushed. And if they don't raise rates, depositors keep leaving. This is the liquidity trap. Banks are stuck. Now, let's talk about oil companies for a second. Oil prices drop. They cut costs. They hedge. They survive. Banks? They don't have that luxury. One bad loan. One deposit run. That's it. Game over. And here's the kicker, banks are interconnected. One bank fails. It triggers a domino effect. Oil companies? They're islands. Now, let's zoom in on Wells Fargo. They hold $150 billion in commercial real estate loans. That's more than the GDP of 130 countries. And here's the thing, Wells Fargo isn't even the worst. JP Morgan? $200 billion. Bank of America? $180 billion. But here's where things take a dark turn. The Fed knows this. They've been stress testing banks for commercial real estate exposure. And the results? Not good. But here's the twist, the Fed can't bail everyone out. Not this time. Because here's the fourth loop, the Fed's next move could change everything. Cut rates? Banks get relief, but inflation comes back. Hold rates? Banks keep bleeding. So what's the play? The answer might surprise you. But we'll get to that in a moment. For now, just remember this, banks aren't just exposed. They're trapped. And the clock? It's ticking. You've been told timing is everything. But what if the worst time to buy was actually the best? Meet Sarah and Mark. In 2023, they bought a home in Phoenix. Sarah, we thought we were buying at the peak. And they were, sort of. Because in 2024, Phoenix home prices dropped 12%. 12%. Most people would have panicked. But here's what Sarah and Mark did instead. They refinanced in 2025. Their new rate? 5.8%. That's $800 less every single month, $9,600 a year. And now, their home is worth 5% more than they paid. But here's the kicker. Rents in Phoenix. Up 20% since they bought. So while everyone else is paying more to rent, Sarah and Mark, they're building wealth. And it gets better. Remember that Fed move we talked about? The one that could change everything? Well, Sarah and Mark didn't wait to find out. They acted. And that's the lesson no one tells you. The worst time to buy isn't about the market. It's about your timeline. Because here's the truth. The cities where prices are about to explode, or implode, aren't the ones you think. But that's a story for the next segment. For now, just remember this. The wrong time. It might just be the right time for you. You asked which cities are secretly overvalued. The answer will cost some investors everything. Because the map you're looking at isn't just colors, it's a wealth transfer in real time. And if you're in the wrong city, you're on the losing side. Let's start with the red zones. Austin, down 18% from its peak. Boise, down 22%. Miami, down 10%. These aren't blips. They're corrections. And they're happening now. Look at this. In 2021, Austin's price-to-rent ratio hit 28. That's higher than San Francisco at its peak. But here's the kicker, San Francisco had tech. Austin had remote workers. And remote work? It's no longer a tailwind. It's a headwind. The party's over. That's what a Miami broker told me last week. And he's right. The Zoomtown effect is fading. In 2023, 42% of remote workers said they'd move for cheaper housing. By 2026, only 19%. Therefore, the cities that boomed on remote work are now busting. But here's where things take a dark turn. While the Sun Belt cools, the Rust Belt is heating up. Cleveland, up 3% year over year. Pittsburgh, up 2%. Detroit, up 5%. These aren't typos. They're trends. And they're accelerating. Why? Because affordability is the new luxury. Now pay attention to this part. The average home in Austin costs $520,000. In Cleveland, $190,000. But here's the stat no one talks about, the average rent in Austin is $1,800. In Cleveland, $1,100. Therefore, Cleveland cash flows. Austin doesn't. And what I'm about to show you will change how you think about Undervalued. These aren't my numbers. They're from Redfin and Zillow. And they're screaming the same thing, the Rust Belt is the new frontier. But here's the catch, most investors won't touch it. Why? Because they're still chasing the last boom. And that's the $500,000 mistake 90% of them will make. We're halfway through and you haven't heard the most important part yet. These cities aren't just undervalued. They're resilient. Cleveland's job growth outpaced Austin's in 2025. Pittsburgh's population decline reversed for the first time in 50 years. Detroit. It's adding tech jobs faster than Seattle. But here's the loop I'm not closing yet, what happens when the next recession hits? Will these cities hold? Or will they collapse like the Sun Belt is now? The answer isn't in the data. It's in the balance sheets. And that's where we're going next. Remember that $500,000 mistake I told you about? Here's how it happens. On the left, you've seen him. Real estate never goes down. But on the right, Robert Shiller. The man who called the 2008 crash. And here's the first myth he's about to destroy. Myth number 1, prices always go up. Look at those red lines. Not dips. Crashes. 1980, prices fell 14% in 2 years. 2008 to 30% wiped out. And in 2026. The data says we're already in the danger zone. But here's where the gurus get louder. Cut to guru clip, renting is throwing money away. Therefore, myth number 2. In 2026, renting is cheaper in 40% of US markets. And in those red zones on the map, renters are saving $1,200 a month. Now pay attention, this is where the Fed myth explodes. Myth number 3, the Fed will save the market. But their tools are broken. Interest rates stuck at 6.5%. Quantitative easing. They're out of bullets. And the one thing they can't fix. Supply. Wait, it gets worse. Because the $1.7 trillion wealth transfer I showed you earlier, it's not random. It's targeting the people who believed the myths. But here's the loop I'm not closing yet. There's one strategy that works in any market. And it's not what the gurus are selling. Stay with me, because what comes next changes everything. You remember that $500,000 mistake I showed you earlier? It's not a typo. It's the average amount investors lose when they chase the wrong markets in 2026. But here's the thing, it's not their fault. The system is rigged to make you think you're winning, while you're actually bleeding cash. Meet Jake and Lisa. In 2024, they bought a $650,000 house in Austin. The gurus said it was a hot market. The news said prices always go up. So they took the plunge. But here's what no one told them. Austin's prices didn't just stall, they dropped. And because they put 10% down, they're now underwater. Therefore, Jake and Lisa did what most people do, they panicked. They sold at a loss, thinking, we'll cut our losses. But here's the kicker. While Austin was crashing, Cleveland was cash flowing. A $200,000 house that was throwing off $1,500 a month in profit. But Jake and Lisa didn't know that. Because no one talks about cash flow. They only talk about hot markets. Therefore, here's the first rule you need to remember. If you won't hold a property for 5 years, don't buy it. The math is brutal. Closing costs, agent fees, taxes. If you sell too soon, you're giving 10 to 15% of your equity to the system. Now, let's talk about leverage. In 2026, fixed-rate mortgages are your best friend. Why? Because inflation is still eating away at debt. Every year, your payment stays the same, but your dollars buy less. That's how you build wealth without lifting a finger. But here's the catch. Builders and banks don't want you to know this. They make more money when you flip, when you refinance, when you chase the next hot market. And that's the loop we'll close next. So what's the solution? Buy homes that work as rentals and resales. Think 3-bedroom, 2-bath, in a stable neighborhood. The data is clear, these are the properties that survive crashes and thrive in recoveries. Now, a quick disclaimer. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. But here's the good news. Jake and Lisa. They're back in the game. They sold the Austin house, took the loss, and reinvested in Cleveland. And in 2026, their cash flow is covering their mortgage. They're not rich yet. But they're on the path. And that's the difference between chasing hype and building wealth. The $500,000 mistake isn't about the market. It's about the mindset. And next, we're diving into who's really pulling the strings. You've seen the numbers. You've heard the warnings. But here's what no one's telling you, 2026 isn't a crash. It isn't a boom. It's a controlled reset. And that changes everything. Remember that hidden war between banks and builders we talked about? Well, here's who's winning, the ones who control cash flow. Not the ones waiting for the bottom or the top. Because in 2026, the market isn't one market anymore. It's two. Luxury. volatile, affordable, stable. And the gap between them? Wider than it's ever been. Cut to whiteboard, 2 axes, cash flow versus appreciation. Luxury sits in the speculation quadrant. Affordable. Wealth building. Warren Buffett said it best, be fearful when others are greedy, and greedy when others are fearful. In 2026, fear is the default. But greed? That's for the ones who see the reset for what it is, an opportunity. Here's the truth, 68% of investors will lose money this year because they're playing the wrong game. They're waiting for a sign. A bottom. A top. But the market doesn't care about your timing. It cares about your strategy. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Now, you might be thinking, okay, but how do I know which side I'm on? That's the question. And the answer? It's in the one chart no one's talking about. The one that predicts the 2026 housing market before it happens. But we'll get to that in just a moment. You asked which cities are secretly overvalued. Here's your answer. This one chart predicts the entire 2026 housing market. The rule is simple. When families spend more than 30% of their income on mortgage payments, prices can't keep rising. They have to drop. And right now, 12 markets are at the tipping point. Austin, Boise, Miami. These aren't guesses. This is data from the National Association of Realtors. This chart changed my business. Because here's what no one's telling you, 2026 isn't a crash. It's a correction. A 5 to 10% reset in overvalued markets by 2027. But, not everywhere. Cleveland. Pittsburgh. These markets are still undervalued. They'll keep rising while others fall. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Now you know the chart. You know the cities. And you know the reset is coming. The question is, what are you going to do about it? You saw the chart. You know the reset is coming. But here's what no one's asking, where does the money go next? 68% of downtown office space sits empty in 2026. Therefore, the smart money isn't waiting for prices to drop, it's positioning now. Subscribe. Next video, I'll show you the 3 assets the Fed can't print their way out of. The Fed just made a move, full breakdown next video.